Stop trying to predict tops and bottoms. That is a dangerous gamble. Flawless execution is the true professional's edge. In 1985, a school teacher named Joe Stowell opened a $5,000 trading account. 2 years later, it was worth $100,000. He never added another cent. He achieved this by waiting for the market to commit before he ever made a move. He found this edge by hand-drawing price charts for 20 years. His research isolated a specific, repeatable 3-candle reversal pattern he called the cups and caps. By the end of this video, you will have his exact mechanical checklist to find this pattern, set your risk, and stop getting chopped up by intraday fakeouts. You only need 2 things to use this system: basic charting software set to a daily time frame, and a clear understanding of a candlestick's high, low, and close. Letting go of the psychological need to predict the future is what separates professional execution from amateur gambling. We react to what the actual market is doing right now, not what we blindly hope it will do tomorrow. Step 1 requires a clear setup. We are looking for a market that has moved aggressively in one direction and has now clearly stalled. If the market just finished a strong rally, we look for the cup, a specific 3-bar formation to sell. Read the absolute lows. The first bar forms a higher low. The second forms a lower low, for cup's bottom. The third forms a higher low. If the market just finished a steep sell-off, we look for the mirror image, the cap, which sets up a buy. Here we read the highs. The 3 bars must form a lower high, then a higher high at the top of the cap, and finally a lower high. A common trap is trying to find these shapes in a sideways, choppy market. Without a prior aggressive rally or sell-off, there is no pattern. An aggressive trend that suddenly stalls creates a structural exhaustion point. The old momentum is spent, and the new momentum is gathering. Step 2 is identifying the exact moment the market commits. Draw a horizontal trigger line at the absolute lowest low of your cup, or the highest high of your cap. Here, most traders fail. They enter the moment price pokes past that trigger line intraday, the early gun mistake. The only valid entry signal is a daily candle that officially and permanently closes beyond all 3 extremes of your formation. Intraday price action is noise. The market is constantly trying to test you. Only the final settlement price counts as a true commitment. Waiting for the close forces the market to prove its directional intent with actual institutional capital before you risk a single cent of your own. Step 3 is boxing the risk. The moment you enter the trade, your stop loss goes at the absolute extreme of the 3-bar formation, the highest high of the cup or the lowest low of the cap. Do not move this stop wider mid-trade. Your fixed risk is the only variable in the market you actually control. Step 4 targets the payoff. Instead of settling for a small, fixed target, you manage the trade for an asymmetrical reward, letting it run to take a large chunk out of the new trend. This chart shows the statistical reality of a 1-to-4 reward ratio. As you push for bigger targets, the win rate drops to roughly 23%. Psychologically difficult for beginners, but notice how the actual profitability, the expectancy per trade, rises. This equity curve shows 26 mechanical cap trades on the NIFTY BANK daily timeframe. It grows steadily over time, entirely absorbing frequent small losses because the few winners pay out so much more. To keep that curve climbing, you have to trade with the larger market direction. Buying a cap in a long-term bull market is highly profitable. Trying to short a cup against that same bull market is a mathematical losing battle. Once your risk is boxed and the market has committed, your only job is to execute the rules and let the statistical edge play out. Here is your daily execution checklist. 1. Find an aggressive trend that stalls into a 3-bar cup or cap. 2. Draw your trigger line. 3. Wait for the daily close beyond that line. 4. Box your risk at the extreme. You now have an objective rule set. You know exactly how to avoid early entry traps and only trade with confirmed momentum. Open your charting software, set it to the daily time frame, and scan the last 6 months for 3 cap formations. Watch what the price action does immediately following that commitment close. Joe Stowell spent 20 years hand-drawing charts to find this edge. You just got the execution rules in 6 minutes. Subscribe to the channel and let's get to work.